Welcome back to Discount Trader. In today's lesson, we are going to break down a complete long setup on the 30-minute time frame. This is a perfect educational example because it includes every important element that a professional trader needs to understand. We will go step by step through the bullish break of structure, the liquidity sweep, the point of interest, the inducement, the buy-side liquidity, and finally, the long entry. I want you to watch the entire sequence very carefully because once you learn this pattern, you will be able to recognize it again and again in the market. Let's get started with step number 1. First, we need to understand the shift in market direction. If you look at the chart, you will notice that the market had been moving lower with a series of declining swings. However, at this point, price finally pushes upward and breaks above the previous major high. This break is not a small break or a random candle spike. It is a clear, decisive break that shows strong participation from buyers. Whenever I see this type of upward break, it tells me that the character of the market has changed. It is no longer in a short-term decline. Instead, it is shifting into a new bullish phase. This break of structure is extremely important because it sets the direction for everything that follows. Without this break, I would not be interested in looking for long opportunities. But because this structure break is clean and strong, I now begin preparing for a potential continuation move toward higher prices. After the bullish break of structure, the market does something very common. Instead of continuing straight upward, it pulls back and sweeps the liquidity sitting below the previous lows. A liquidity sweep happens when the market dips below a level where many traders place their stop losses or enter early positions. This sweep tells us that the market is collecting sell-side liquidity. Why does this matter? Because large players cannot move the market without gathering liquidity from the opposite side. When the market dips and sweeps these lows, it gives the buyers enough liquidity to push the market upward again with strength. So at this point in the chart, we have two confirmations. The structure is bullish and liquidity has been taken. This combination increases the probability of a high-quality, long setup. Now, let's look at the point of interest. A point of interest is simply an area where smart money participants have previously entered substantial positions. On the chart, this zone was created before the bullish break of structure. When the market returns to this zone after sweeping liquidity, that is our first major sign of a potential bullish reaction. Why is this zone so powerful? Because it represents an area where institutional orders were originally placed. Institutions often come back to these areas to mitigate, rebalance, or re-enter their positions. When price returns to the point of interest on the 30-minute time frame, it shows us that the market has come back into discount pricing. This is where I prefer to look for long entries. Price is no longer at a premium. It is now at a discounted area where buyers are likely to re-enter. Before the market taps into the point of interest, we notice a smaller, temporary low forming just above the zone. This is what we call inducement. Inducement is a clever behavior of the market designed to trap early traders and create extra liquidity. When this small low is formed, many traders mistakenly enter buy trades too early. They place their stop losses right below this smaller low. This creates a fresh pool of liquidity that the market can use before making the real move. So what happens next? The market drops just enough to take out this inducement low, collects that liquidity, and then finally taps perfectly into the main point of interest. This sequence is extremely reliable. The inducement gives us a final confirmation that the market is preparing for a strong, bullish move. Once price reacts from the point of interest, we must decide where the market is likely headed. The most logical target is the buy-side liquidity sitting above the previous major high. This high contains resting stop losses of traders who were selling. It also contains breakout buy orders from traders who enter late. Smart money traders understand that the market is naturally attracted to these areas, so this previous high becomes our target for the long trade. It is not a random target. It is a liquidity pool that price wants to reach. Now let's talk about the actual trade execution. Once the market sweeps the inducement and taps directly into the point of interest, that is where I consider entering my long position. This is the most efficient entry point because price is at its discount and has collected all the required liquidity. For risk management, my stop loss is placed below the extreme of the point of interest. This keeps the trade protected while maintaining a favorable risk-to-reward ratio. My take-profit target is the buy-side liquidity above the major high. This gives the trade a clear direction and an achievable target. As price moves upward from the point of interest, it respects the bullish sequence beautifully. There is no hesitation in the reaction. Price continues rising and eventually hits the buy-side liquidity level exactly as expected. This is the power of trading with structure, liquidity, and institutional logic. This is the discount trader method. Thank you for watching this complete breakdown on the 30-minute time frame. I hope you learned something valuable from seeing the entire sequence, from the first break of structure all the way to the final take-profit target. If you want more clean breakdowns like this, make sure to subscribe to Discount Trader and stay tuned for the next video. Thanks again, and trade safe.